PassivePockets is presented by Equity Trust.
Before we get into this special deal review episode, here are the required disclaimers that remind you that all investments carry risk and that none of this commentary is intended to be financial, tax, or legal advice. This program is intended to display how experienced LPs analyze a deal and question a sponsor. Now let's get to it.
Hello, passive investors. Welcome to our exclusive deal review webinar. I'm your host, Paul Shannon. Our goal is to equip you with the tools and insights to confidently step into passive real estate investing as a limited partner. One of the best ways to do that is by reviewing deal after deal after deal to understand what separates a great investment from a bad one. In this episode, we've invited Drew Wahlgren from MagCP Partners to present one of their latest deals. And joining me on the panel are our experienced LPs, Lopez and Mauricio Rauld. Here's a review of the format. Drew will have 10 minutes to present a basic overview of the Industrial Fund 3 presented by MagCP Partners. Next, Chris, Mauricio, and I will have 15 minutes to pose questions to Drew and learn more about the deal. Then, we'll let them both go, and our panel will discuss the deal amongst ourselves. As a reminder, this is called passive investing, but your work begins with evaluating all of the underlying documents and information. This webinar is intended to augment that and help you figure out how to analyze a deal and question a sponsor. Let's get to it. All right, Drew, this is the first part of the show where you give us a brief synopsis of the fund and any high-level points that you want to make to our audience here. It'd be great if you get us started.
Thanks, Paul. Great to see you all. I'll jump right in. Today, I'll be presenting MagCP Industrial Fund 3 to you all. Quick disclaimer, this is just a summary, and any investors should absolutely review PPM and all operating agreements and other docs before proceeding with an investment. Quick summary on us, MagCP Partners. We've been around for, I guess, in our 11th year now at this point. Since 2015, we've been investing as a private real estate investment firm, primarily in single tenant net lease industrial real estates. Today, we manage about $1.2 billion in assets under management, have a very low tenant default rates, and have gone full cycle on about 38 investments, which comes out to a little over $200 million in investments that have gone full cycle, realizing an average of about 17% IRR to our LP investors. Quick overview of where we're investing, really across the country, but where we're finding a lot of industrial opportunities that we like are concentrated a little bit in the Midwest, but we are agnostic. As you see, we invest in the Southeast, even on the coast, where an opportunity makes sense. But really, if you draw a line from Michigan to Texas, you see kind of a cluster there as we focus many times on industrial real estate backed by manufacturing tenants. We're fully vertically integrated, so in-house construction facilities management, in-house credit advisory. We even have a private equity wing, which is separate from this fund, and manage funds as well as other JV investments. Quick highlight here on Industrial Fund 3. This is a fund where we are aggregating single tenant net lease industrial real estate across a portfolio with the intention to hold for 5 years. We're raising $200 million in equity. That's a 1.9x multiple on invested capital across that hold period. Target cash on cash is 6 to 8%, with an 8 to 10% preferred return. That's dependent on ticket size that invests. 15% projected net IRR to our investors using a pretty moderate amount of leverage, averaging about 65%. We'll distribute cash flow on a quarterly basis along with reporting. We have both a direct tax-advantaged investment opportunity as well as a tax-advantaged REIT feeder opportunity that also goes into the fund. So really, what are our core fundamentals? We're investing in stabilized, absolute triple net lease industrial real estate that's stabilized and cash flowing from day one. So we really take a hard look at tenants and their credit because that's where the concentration of risk lies, is within single tenant default risk. Again, our in-house credit advisory team, we've hired these guys from institutional shops, a lot of publicly traded REITs, built out that team where we're able to dive in deep, spread the financials of these tenants, talk to the management team, and really understand the risk around their ability to pay rent. Typically, these are 10 to 20 years in lease term. And with an absolute triple net lease, the tenant is responsible for everything fence line to fence line, including insurance, taxes, utilities, but also roof and structure, landscaping, HVAC. So the investment is really into a property where we have protected ourselves and insulated ourselves from operational expenses at the real estate while building a very long-term commitment from a single tenant with 100% occupancy of the property with annual rent bumps built in, while pairing that with fixed rate debt that's fully amortized. So over time, we are paying down debt, increasing NOI each year in a very predictable manner, and seeing a very predictable cash flow as a result of that to our LP investors. The fund really helps us diversify this risk with our tenant base across this portfolio, which will be around 25 to 30 total assets. So we're diversifying not only in location geographically, but also in tenant credit profiles, tenant industries, amongst also some of their private equity sponsorship above some of these tenant businesses, which are primarily manufacturers and food producers. We like this model a lot. It allows us to scale without having a huge increase in management. Again, these are long-term net lease single tenant properties. And what we're building here is this hedge against inflation. We don't know where inflation will go in the future, but it's still a battle that is being fought at the moment. And what that means for us is that if the cost of insurance, utilities, taxes, all that increases, that falls on our tenants. So we're really well protected against that while seeing typically 2 to 3% annual rent escalations built into these leases. And really, I want to focus just for a moment on our niche, which is sale leaseback transactions. So in this investment or this transaction, we're buying an owner-operated property. So a Joe's Manufacturing Company who owns and operates their business out of the facility is selling the real estate. And at closing of our acquisition of the real estate, they're simultaneously signing a new, usually 15 to 20 year absolute net lease. What this is for the seller is really a financing transaction. They're unlocking equity that's trapped in the real estate so that they can inject that into the growth of their business. This is an alternative to a line of credit on the property or even a term loan from a bank. And there's a number of different reasons that sellers will do this, but oftentimes there's a lot more flexibility there. Frankly, are managing maybe covenants with another term loan that they have, or it could be a private equity group who's buying a business and simultaneously looking to do a sale leaseback to lower their basis on the acquisition. So they might be buying the company and the real estate and say, we don't want to tie up our money in the real estate, and we'd like to simultaneously spin off the real estate as we acquire this business in order to do that. And again, for us, we have a stabilized 100% occupancy property with a long-term net lease, annual rent bumps, and everything I just mentioned earlier. So within that strategy, there is cash flow that's very strong from day one. Again, 6 to 8% is our target there. And within that strategy, it's very conservative and we've insulated ourselves from a lot of risk, but we're still able to find ways to add value over time as well. As a baseline, again, we're increasing NOI by that 2 to 3% per year, which is very much baked into the cake of that lease. We're also paying down debt. But within that, we find opportunities to help our tenants. That's through tenant expansions and developments where the company's growing and we're able to develop a 100,000 square feet, let's just say, expansion for them to store more materials or add more production lines, whatever the need may be, in return for an increase in rent and usually with a new set of term on the lease. We can also put CapEx into the properties on behalf of the tenant, again, in exchange for increased rents. Another way to add value is lease renegotiations. We can add term to the lease or convert maybe a triple net lease to an absolute triple net lease, further enhancing the value of the assets. So how do we mitigate risk? Again, in-house credit advisory. This is the biggest piece here, is understanding the risk of the tenant, their historical performance, and what their balance sheet looks like today, and looking for moderate levels of leverage on the business. And of course, looking at the entire competitive landscape. What industry are they in? Who are their competitors? What risks do, say, tariffs place on them? So there's a lot of examples, and that can vary from industry to industry and from business to business. But we're specifically looking at the unit profitability of the location that we're buying, whether it's a single location tenant that is operating just out of the single property, or if they have multiple locations, we want to see unit profitability and understand that this is a critical piece of operational real estate for this tenant. And that's a huge mitigation of risk should the tenant get into some trouble financially. And then behind all that, of course, is the real estate. The asset itself that we're buying, we want a defensible basis there that's much lower. Usually we're aiming at 50 to 70% of replacement costs on the property itself. And of course, looking at market rents being at or below market rents should we ever run into a vacancy and need to release. Target debt assumptions, typically 5 to 10 years in term, always fixed rates, 60 to 70% loan to value typically. And we'll have a blend. Mostly 25-year amortization schedules are what we see by sourcing debt from regional banks, credit unions, even some institutional credit facilities. But we'll sprinkle in some interest only as well to enhance yield to our investors. So we eliminate and reduce prepayment penalties wherever possible as well. We'll have a mixture of some single asset loans as well as some credit facilities that we'll be able to finance a number of assets with. So quick timeline here, we're going to be investing over about a 12-month period, deploying that capital raised and calling those commitments as we deploy into these assets. Again, about 25 to 30 assets in total. After that, years 1 through 5 will be a hold period where we are cash flowing, enjoying that cash flow, and of course, passing through depreciation to our investors. And at the end, a disposition of the portfolio through a sale. Quick projection, this is just a nice visual, but really what you're looking at is at about year 6, you've received about 40 to 45% of your capital back in just cash flow. So this is a very nice way to mitigate risk for real estate investors, is to see cash flow, because with every distribution, your risk goes down as further cash flow comes in, and you're seeing a return of capital over that time. And then, of course, again, at the end of the investment cycle, we will sell the portfolio, return capital and profits to investors. Quick overview on terms. Again, $200 million equity raise. That's expandable up to $500 million should we see the demand there. Fund term, again, 5 years from the final closing date, 3 one-year extensions beyond that. And the offering term is, again, 12 months after the initial closing date. I will mention that our first closing is in about 2.5 weeks from now, an acquisition of a 6-property portfolio in a sale leaseback transaction. We talked about target debt, and with the structure in the waterfall is 100% of principal return first, compounded preferred return hurdle must be met, and then there's a GP catch-up, followed by a GP-LP split, which we'll see in just a moment here, but again, dependent on ticket size. Preferred return also varies on ticket size. Minimum investment for the direct option is $250,000, and the REIT option is a $75,000 investment minimum. Our acquisition fee is 1.25% on the purchase price of the real estate. Our management fee, again, varies dependent on ticket size from 1.5% to 2% annually on committed equity. Investor eligibility, accredited investors only in this particular offering. And types, we can take investment capital from a number of different entities, whether it's solo 401k, self-directed IRAs, and any other sort of corporate LLC entity. We do have a overseas corporate blocker that we can form should the need arise. And funding commitments, anything at $250,000 or less will be called in full upon signing at the first capital call. So again, we're right around the corner from that first capital call to support this first closing. Distributions and reporting will be done quarterly. We'll have a minimum of 2% GP co-invest, which is $5 million in co-investment based on a $250 million equity raise. But not only that, we'll be signing carve-out guarantees as well as full recourse guarantees on much of the debt used in the fund. We do use some outside parties, very institutional grade parties for legal, as well as fund administration, as well as Eisner-Ampner for annual audits of the fund. Quick overview here, just some sliding scale of preferred economics that come with increased ticket size. I will mention to all of your viewers that we do have an early funding incentive for anyone who commits before the end of March. We'll get an automatic bump up in class, meaning from a minimum investment would take you up into from A1 class to A2. I won't spend too much time on the differences between the REIT and the direct fund, but quick snapshot of our previous 2 funds, Fund 1 and 2, $60 million in equity followed by $80 million in equity. Those are fully deployed and stabilized today, and average cash on cash about 6.9% in Fund 1 since inception, and Fund 2 at 7.4% or so since inception. And those are across 10 quarters and 8 quarters respectively. So I'll pause there and I can take down the presentation if you want, and we can open it up for questions if you'd like.
Drew, thank you very much for the concise presentation, impressive track record, and it seems like a very interesting time for industrial to capitalize on what's happening with onshoring of manufacturing and such. We're going to dive into the second portion of the show now and get into some of the questions that our LP panel has. We've got Mauricio Rauld here and Chris Lopez. Mauricio, you want to kick us off here?
Drew, thanks so much for an awesome presentation. Obviously, your track record precedes you guys. But I am going to focus on that as an LP investor. One of my, especially with the blind funds in a syndication in general, single asset, but especially on a blind fund, I put a lot of emphasis, the vast majority of my emphasis on the sponsor team and the track record and all that stuff, which on a preliminary overview, you guys look like just a wealth of experience. Talk to me a little bit about your transactions. I know in the presentation you mentioned, I think 150 transactions, $1.5 billion in transaction dollar amounts. How many of those have been in industrial? Like what's the track record specific to the industrial space that obviously is the subject of this particular fund?
Yeah, thanks for the question. About 70% of our portfolio is really focused here, single tenant, net lease, industrial real estate. So we've really started with our first investment in 2016. A lot of the background of the founding principles came from development. And as they looked at further development opportunities, they were looking for cash flow. And they made their first offer in 2015 on a sale leaseback in Idaho Falls, got completely blown out of the water by institutional groups and said, what is this, right? Why are these guys coming in to blow us out of the water on a transaction like this? And it took a little time for a group of real estate guys to really understand credit and the risk there. And over time, we built out that in-house advisory team to understand that even further over time. So yeah, at this point, it's been 10 years of these transactions and it's the majority of our focus. We're opportunistic outside of that as well. But, again, the majority of the transactions and the deal flow we get from being in the space so long is really strong there because we have a reputation in the brokerage community as well as the private equity groups who are transacting in these businesses and looking for a real estate / capital partner here. So for a seller in a sale leaseback, execution is most important. And so we oftentimes get the first look or even sort of a quasi off-market deal for someone who wants to have a quiet transaction that can get done in 90 days. So that's been really helpful there. So hopefully that helps with why we're so focused there, why we have so much deal flow there, and why that's still been our focus. And Paul mentioned earlier, there's a lot of tailwinds in industrial real estate, and we feel like that there's a 10-year runway ahead of us of a very strong performance there.
Cool. Would you say also the majority of those full cycle deals and also in the industrial space, somewhere around 70% or so?
Yeah, about that. Exactly. And full cycle deals, I'd say about 70%.
Cool. And the other quick question before I turn it over to Chris too, was just in terms of your guys' involvement. I mean, let's say I write you a check for a couple $100,000 or whatever the number is. Are you going to be my point of contact? What's your specific involvement? Are you doing the acquisition? Are you doing the asset management? Like maybe talking a little bit about the specific role that each of the principals is making in the deal.
I think I understood the question, but, kind of at a granular level, when an investor commits, they are dealing directly with me or someone else on our capital markets team with any questions. But once they commit, there is the sort of granular level of management coming from Standish, our fund administrator. And really, that's just a matter of going through documents, making sure those are signed up, going up to the capital call, which is next, and funding instructions. But that's all really logistically there, right? So any investor, of course, has access to any of us on our capital markets team. Hey, reach out, questions. But of course, the quarterly reports are meant to sort of communicate that holistically so everyone understands what's happening, developments in the fund, performance, and all of that. So shouldn't have additional questions beyond that. But, we're all human beings. And I totally get it when an investor calls and says, hey, tell me a little bit more what's happening. And oftentimes people do come in with second and third tranches of capital after they see the performance going very well. We've seen that in the last two funds. From a manager perspective, we're the sole manager of the fund. There's no other co-GPs. We raise capital in-house. The only thing outside of that, really some work with some broker dealers. But again, we are the sole manager of the fund.
Great presentation. And to follow up on Mauricio's question, I agree. Like when it comes to funds, I think the sponsor track record is the most important. Like I love funds for diversification. Hey, one check into many deals. I was looking at the PPM and it said the fund launched in July of 2024. When did you officially launch it? And then how much capital have you raised? Because I assume now, since recording almost in March, you would have had at least a deal in the fund based off of the launch of it. But walk me through kind of like a pipeline of deals, pipeline of capital, if you would.
Yeah, we formed the fund about middle of last year. And that was really a formation of it. We did a soft launch of it saying, hey, Fund 3 is formed. We're taking capital commitments now. But we really focused our acquisition efforts on closing out our last fund at that moment. But of course, being set up to begin raising commitments and roll right from Fund 2 right into Fund 3. So we've had a couple acquisitions that we thought were going to close in November, December of last year that have slid back a little bit. Right now, we have our next two closings are scheduled for by the end of March, one middle of March, one end of March. And again, one's a 6-property portfolio. Another is a 2-property portfolio. There are 3 other acquisitions right behind that, all with at least dual signed LOIs, if not in contract. So there is about 120 million in acquisitions or so in asset value that are tied up at the moment. So, we are certainly hitting the ground running here with a hard launch of the fund that began about a month ago, where we're saying, look, we are right now about to start putting this money to work. And the advantage here with these assets are that they're cash flowing immediately. So very advantageous for investors to come in earlier, whereas many funds, folks want to wait until later because it might be a value add strategy. And they'll say, look, I want to come in a little bit later when I'm a little closer to cash flow. So again, at these assets closing stabilized from day one, we would anticipate our first distribution at the end of Q2, right? So we're right here at the end of Q1 or so. Again, first couple acquisitions coming right at the end of the quarter. So that's an advantage there. And just to kind of circle back to what both you and Mauricio said about sponsor experience with the fund, right? You're coming in, what's the focus? What's the experience of the sponsor here? You're certainly betting more on the jockey than the horse when you're looking at a fund and the manager. We've done really well with our last 2 funds because we focused on this exact strategy, again, for 10 years. So when we launched our first fund, we had a lot of repeat investors, a lot of fans and partners that we've been with for a long time said, I know exactly what you're going to do because I've seen you do it numerous times and I've invested numerous times. I'm very comfortable here because I know that you're not going to loop in some out-of-the-box deal. So we're a bit rhythmic in our deal flow and almost to the point of boringness. To be honest, I do have some people say, let me guess, another 20-year sale leaseback, the absolute net lease industrial property in a secondary market like Columbus, or Cleveland, Ohio. And I say, yeah, that's pretty much it. But it's always exciting to be able to share the details of the tenant, the business that they're in, and some nuances there. But yeah, we're very hyper focused within that small slice of the real estate pie.
Some great questions from the panel thus far. And just to piggyback off what you said before, Drew, I'm one of those investors that has found predictable returns in your portfolio of offerings and, full disclosure. But when I look at this, I guess one of my concerns is that there's going to be a really concentrated period of time for about 12 months where you're going to be on an acquisition mission. You're going to have capital to deploy. And right now we seem to be at a time in the market where things are still relatively high. We may have had a correction in some asset classes, but where is industrial right now in your head, just from a macro thesis standpoint? Where does it fit into the global economy? We obviously know that there's some onshoring happening right now that maybe provides some tailwinds, but there's some headwinds too in the form of tariffs, as you alluded to. So just want to make sure, like, if you are going to get into something like this and you're sort of hyper concentrated within that annum, that you're not, getting in at the top, basically. So what would you say to someone that has that similar concern?
At a high level, really just looking at the last 5 years, we've seen a lot of changes, right? So post-COVID, there was a mass amount of construction and investment into logistics, which is really not our primary focus. We do own some 3PL sites, but for the most part, again, our tenants are in manufacturing. Really, if you were to boil down our thesis, we believe in the power and critical nature of American manufacturers across the U.S., and are investing in the critical real estate that supports them. So that being said, there was really a structural change after about 2021 when all the supply chains were in chaos and companies started to realize, okay, we have numerous supply chains sourcing parts, supplies, whatever it might be from around the world. We need to really mitigate the risk on some of these more critical supply chains, something that's more bespoke, something that is going to be more difficult for me to change suppliers very quickly. We saw that with semiconductors as a prime example of that. Ford had that big fleet of trucks sitting out there doing nothing. Really, that's a structural shift that we're seeing. And tariffs really benefit a lot of our tenants, actually. These are American manufacturing companies producing products here. So if it means that their competition globally has now an additional tariff that decreases their competitiveness in the marketplace, then that's advantageous to our tenants. But at the end of the day, most of these tenants that we're working with are companies that have been around from anywhere from 40 to 100 years. They're in boring businesses. They manufacture widgets and parts, supplies. And again, we see them as critical businesses. And each one is very case by case, which industry they're in and really which industries they serve. But again, we don't see anything really other than a tailwind for them should there be tariffs on imported goods from out of country, because we are investing in American industrial real estate tenanted by American manufacturing companies. So yeah, I think we could see some turmoil and of course some reciprocal tariffs And depending on the tenants and who their customers are and where they are, that's something that we're going to have to look at in a case-by-case basis and say, look, if there's a lot of exported goods from this particular manufacturer, we need to really see what kind of risks there are and how much concentration there are if most of the product is going to, let's say, Mexico, and we get into a tariff war with Mexico. So these are all top of mind, right? And we have to consider those really carefully, and again, on a case-by-case basis. But zeroing in on the other part of your question, really, as we've seen over the last few years with interest rates rising, we've also seen an increase in cap rate, right? And so we've seen that shift almost in lockstep. Cap rates tend to lag interest rate changes a little bit, but we've seen that over the course of Fund 1, actually. Rates were going up during that deployment period in that first fund, and we were able to command higher cap rates and maintain what we're always looking for, which is about 150 to 200 basis point spread between the fixed interest rate on the financing we're using and the cap rate we're buying at, meaning that we're using positive leverage on every dollar that we borrow. So we've been able to maintain that spread. So, the question is, why now? And again, we talked about long-term industrial strength and the structural change and sort of away from globalization, right? And the Trump administration is certainly in favor of that as well. But you have this pricing that's much softer. We're buying on average in the 8 to 8.25% cap rate. And interest rates are varying. We've seen everything from 6.25% to 7% on fixed rate financing. So we're able to, again, maintain a spread there, positive leverage, cash flow with fully amortized debt. It's very hard to find that in the marketplace today, a real estate equity investment that cash flows from day one. So that's been really great. And so to look at the fundamentals of industrial real estate and go, look, these are really strong, and I'm buying at softer prices than we've seen, the soft end of the spectrum that we've seen in the last 15, 20 years, it's pretty compelling.
Great answer. Thank you, Drew. Chris, I think you had one before I jumped in there.
I do. I was actually going to make a comment first on the fund, just for a lot of the LPs out there in general. Like, I always view there's three main phases when coming to a fund. Early stage like this, which is, you have a lot less knowns out there, or you can come in during the middle or towards the end. Ideally, everyone likes to come in last minute, right? Hey, we see 90% of the portfolio. We know what's in there versus, hey, what the PPM says we'll acquire. And I just want to point that out for, LPs, be aware of that, because you mentioned earlier, Drew, that since you are kind of in the early stages, you're offering some preferential economics. Could you talk about what you're doing? Because you said people go from the A1 to A2, or they get a bump up in the class share. Could you explain that and talk about what that means when it comes in now and the bump they would get in their returns?
Absolutely. So there's 4 investment classes, and really it's designed to be able to serve the institutional equity investors, those allocators of public pension funds, large family offices who really come to expect institutional terms on a fund like this. And so, they frankly expect 1.5% management fee. That's really within the realm there. And that's aggressive, but should they get that if they're writing a $20 million check? Probably, right? And that's just natural in the business we're in. So at a minimum, the terms, I should say, are still very competitive, right? So at a minimum of $75,000, you have an 8% preferred return and a 75-25 split. Now with an automatic bump up to the next class, that goes up to a 9% pref and a 80-20 split. And the management fee also comes down a bit from a 2% management fee to a 1.9%. So with a reduction of management fee, you actually see net cash flow to the LPs increase as that management fee declines. So oftentimes you don't see any kind of changes to cash flow in a fund if they change the split or even the pref, if that's just accruing. But in this case, that's an actual rubber on the road material change to cash flow to the LPs. So yeah, if someone's saying, look, I'm very comfortable here, this is a lower risk investment, I'm willing to write a larger check, let's just say it's $500,000, that would get bumped up to the next class above that. And then of course at 7 figures, you'd be really in that institutional grade of terms or set of terms, which a very low management fee, a very high preferred return of 10% and an 80-20 split. So hopefully that makes sense. But I always, again, remind people, with a stabilized, immediately cash flowing asset class like this, you go, do I want to invest later? Or if I'm sitting on cash, if I invest now, I can participate in cash flow immediately. If you're looking for income from real estate, why not invest sooner? And then, of course, there's an incentive to come in on the front end. Fund managers tend to give an incentive on the early side because fund investors do like to see more assets in the fund. But again, this is a strategy we've been using for a very long time. And I didn't present it here, but we do have an overview of each one of those assets that are tied up in acquisition. I know we're limited on time here, but I'm happy to share that with any investors who actually want to see what are the assets that are going in. I really want to dig in, even that if that means that's 25% of the total fund allocation.
I've got about 8 or 10 points. Obviously, we're not going to get to all of them, but maybe I'll just actually list them just so if people are listening, the kind of things that I was kind of thinking through. So, I mean, I want to talk about your waterfall for sure, because actually I really liked how you were structuring the waterfall. I thought that was a huge positive. So I want to just confirm that my understanding is exactly that. I know you've got a REIT class on what was going to talk about that, side letter, cash calls. There's a kind of a forced withdrawal provision potentially, and then reporting and some other stuff like that. But let's talk about the waterfall, because one of the things that I really liked, as I understood it, you were literally giving not only from the disposition of the asset, but also from the cash flow, from the from the rents and the dividends. 100% of that was going to the LP until they were basically made whole, until their aggregate contribution was there, and then after that, you would 100% would continue to go to the LPs until they got their preferred return. And then you would do the catch up and then you split it, whatever you are. That's not typical. A lot of syndications generally start splitting 80, 20, 75 on the cash flow. And so, on disposition, you see that a lot. But is my understanding correct that even from the cash flow, you guys aren't getting any of your carried interest until I've been made whole plus my preferred return, right?
That's correct. Yeah. And this is something, a waterfall, it's a little more common in the institutional world. And this is a different waterfall than our first two funds, because again, being a larger fund and having courted the institutional equity side of the world for the last 2 years and sort of in anticipation of partnership in Fund 3, we changed the structure to be more suitable for, frankly, what they're used to. And I agree with you. I like it a lot. It's return of capital. And even though that capital balance is going down, that preferred return is compounding. So it's not exact, but it stays about the same total preferred return accrual over the course of that hold period, if that makes sense.
Yeah. So the preferred is based on the unrecovered capital, or not based on my initial capital?
Correct. Your capital balance is going down, but again, the preferred return compounds. So in the first year, you might accrue 8% preferred return at the base class, and so that amount would be added to the total capital left that preferred return is based on. I know it's a little complex, but in short, it's not that with $100,000 investments, after 5 years, you're not, instead of $8,000 of preferred return accruing, it's not, $5,000 because of that compounding effect.
Talk to me a little bit about, I didn't get a chance to view the operating agreement or the partnership agreement, but in terms of the different classes, I assume there is the REIT one of those classes? Is the feeder fund coming in through one of those classes, or that even a completely separate class?
Totally separate. Yeah, the classes are just, again, preferred economics, and these are all sitting in the same class of equity. I just want to make sure that's very clear. This is all just GP concession, right? So as an investor writes a larger ticket size, we're conceding more of the GP end, whether that's the preferred return hurdle and the split. So it doesn't affect other investors, again, all sitting in the same class of equity. There's no preferred equity or anything else. Now, the REIT feeder is just a inline vehicle that investors are coming into the REIT feeder, and the REIT feeder is investing directly into the fund, and cash flow goes the other direction. So 100% of cash flows that come into the REIT will be passed through to LP investors. And really, it's the same exact performance. There's no additional fees, same exact structure based on, again, investment class, ticket size. However, it gets different tax treatment. Yeah,
that's actually just a quick comment, and then I'll pass it back to you, Chris and Paul. It's interesting because a lot of times when you're dealing with institutional investors or family offices, they tend to want, either priority in the capital stack or say, being on the board of advisors, hey, before you can make any type of decisions, you need to run it by me. Is that the case here, or is everybody pretty much equal in terms of if I'm putting in $250, I'm going to have the same voting, the same say, the same everything that an institutional, or does the institutional have sort of requests that they've made that you're going to be acquiescing towards the management of the fund?
We're not giving away management seats to institutional investors. So yeah, they would still sit in the same LP pool of investors. Again, with preferred economics. And again, we're giving up a little more GP to someone who's writing a check that's $5 million and up. hopefully that answers the question.
Yeah, because the ones I've seen, usually it's like, oh, my first money's in, first money's out. You need to approve the budgets with me. And like they have all these sort of strings attached when they write the big check. But it sounds like here they're just getting the economic benefits of writing a big check.
Trust me, we've talked to many of these folks who do want a joint venture fund. And, at some point we might do something on the side for them, something that doesn't compete with this fund, right? And there's ways to do that, of course, to keep them very separate. But in those cases, a lot of folks that write a $100 million check will say, I want, veto power, approval power. So in this case, we're not giving that up.
I want you to touch on just the internal mechanism for evaluating credit tenant worthiness as you're looking at these businesses. Industrial real estate's a little bit different than some other classes of real estate, where as the lease term winds down, the location and the physical asset become more important. But if you've got a long lease runway, like 15 years, 20 years, like you do in these sale leaseback transactions, it's really the credit's tenant worthiness that matters the most. So can you maybe talk to us about how you evaluate those businesses? Can you maybe provide us an example of a time where you've been in due diligence and you found some things that you didn't like about the business and decided to back away from a deal if there has been one of those scenarios? And then touch on how maybe over the course of the hold period, maybe, the financial situation of that tenant changes, which it certainly could given the uncertainty of today's economy. What sort of rights do you have as Mag Capital?
I'm going to get through the first one and then you're going to have to remind me of the second one really quick. But as far as diving into the credit, it's really interesting because we're not investing in a corporate bond, but it has a lot of similar characteristics, right? The returns and the cash flow are securitized by the health of this business, right? But on the other hand, we have better collateral. We're holding a real asset, industrial real estate. And again, as long as the basis is defensible, we can reposition that should we lose a tenant. For context, though, we've had 110 plus single tenant properties. We've only ever had one tenant ever default on their lease. So very uncommon occurrence, but we're obsessed with the risk around there as we need to be. And now you start to look at sort of the other factors, because I think the credit analysis of the business, it can seem a little simple when you just first look at it, but you're also looking at, again, what's the basis on the real estate? And then how versatile is the property? And most of these are very much versatile, right? 4 walls and a roof, open floor plan can be used for a number of different uses. The market that they're in, how much vacancy is there in Minneapolis, Minnesota, right? I mean, all these factors have to come into place because you might be willing to take a smaller credit or a weaker credit if it's in a really primary location in Phoenix, for instance. And say, look, there's a huge amount of demand, very low vacancy rate. We feel that we could reposition this in very short order. Whereas, again, if I'm in the 45 minutes outside of Minneapolis, again, it's just a different example. You might say, look, this may take longer to reposition. So we want a much stronger credit that we feel much more comfortable with going into it. And then you factor in ownership and management. Many of these companies have private equity sponsorship. We're going to look at them. What's their track record been like? What's their strategy? What's their intention? Do they want to roll up other businesses into this platform and sell to a larger private equity group? Happens every day. What kind of leverage do they plan on using? Again, if we're doing a sale leaseback in simultaneous to their acquisition of a business, we want to see the historical performance of the company, but also what's the post-transaction leverage look like? Many people have heard the horror stories of, over-leveraged buyouts of businesses. And that's something that we're going to look at really carefully. The advantage here in the sale leaseback is we have the cooperation and demand that of the seller to see the entire playbook, all their financials, and understand that really well. There's been some that, we've walked away with where you have kind of a shifty seller that we just can't get comfortable with. We're asking for financials. Things don't add up. Maybe they're not audited, but they don't look very clear. And our credit advisory team, as I mentioned, is really well experienced. I mean, there's been a lot where I've said, what's going on here? I thought that we're moving forward. And they said, well, they can smell problems from a mile away and they just dig in. They're like a dog when you start to get some sort of response from a seller and that doesn't line up or isn't consistent. They just fixate on it until they dive in deep and either it makes sense or it doesn't. So there have been many deals we've walked away from, whether we're not comfortable with the credit or whether we just get outbid, frankly. And actually, this first acquisition that I mentioned, 6 property portfolios, one that we lost the deal originally to JP Morgan Net Lease. The seller really didn't like the way the institutional group was sort of handling the transaction. It's a much larger group. You can imagine layers of committees to push it through. There was some uncertainty there. And many months later, they came back to us and said, hey, if the offer's still on the table, we'd rather work with you, even if it means that we're giving up some proceeds on the sale of the asset because we're valuing execution first. Those things tend to work themselves out. Now, remind me of the follow-up question you had.
Just if MAG has any reciprocation if financial conditions change in the tenant during the hold period.
No, we don't have any control over the tenants. Basically, we do have some language, and I should mention in the leases, we do require them to report to us quarterly, their financials, P&L, and balance sheets. So we monitor them closely over time. If the organization's big enough, typically they'll have audited financials. So we'll look at that on an annual basis as well. And that's really just to understand what's going on, see if there's any degradation in the financials, ask questions, prepare ourselves should we really see problems being written on the wall. And where it gets a little more nuanced is assignment language of the lease. Now, this goes back to kind of what you said, have you ever walked away from a deal? Again, many, but one particular example in a case with a tenant or would-be tenant who frankly wasn't willing to let us have some guardrails around assignment language. So what that means is private equity group says we might sell this company to a new buyer. For us, we want to have some, again, guardrails to protect us should they sell to a new buyer who uses an inordinate amount of leverage, let's say. So we'll say, look, we expect debt to EBITDA ratios to be within these bounds. Also to have the top level parent guarantee on the organization. Now, some of these organizations are complex, multiple LLCs, sister companies. So we want to know that this company isn't being sold to another buyer and then the guarantor on the lease is a relatively small entity that instead of having $100 million in revenue behind the lease, we have a $10 million entity, which could be washed out very quickly. It gets a little more nuanced there. It's very sophisticated. Again, this is something we're used to, and we see these things. And again, the private equity group is going to manage this company to the best of its ability. They have access to capital. We like that world and that group, but we do need to protect ourselves and our investors and look at what the future might hold should they sell this business.
Excellent. Thanks, Drew. Mauricio, do you have a final question for Drew?
I like to ask, what keeps you up at night? Like, what's the risk that you are most concerned about in this particular fund? I mean, you mentioned these are single tenant. It's a single point failure. So all of your focus goes into that single fund, and the quality of the lease, I guess, is another one. Is there any concern about the length of the lease at sale? Because obviously you're acquiring these properties, you're doing the lease back, so you're starting at a 15 or 20, I think sometimes it maybe even 10. Let's assume it's a 10-year lease. Fast forward 7 years and you're trying to sell the property. Well, now the tenant only has 3 years left on their lease terms, and there's potentially a risk that they may or may not renew. Do you ever see that? Is that a potential risk of what's left of the lease, or is there another risk that keeps you up at night other than the ones you've already mentioned?
Yeah, from our experience, you typically see cap rate expansion on a property as you get below about 8 to 10 years in lease term, right? As you're approaching that lease renewal risk. That's why, again, we target 15 to 20 years. Yeah, in our materials, it says 10 plus years. 10-year lease would really be an exception. And in that case, it would probably be in the case where you have a rent that's well below market, where in those cases, you actually approach lease renewal risk and it becomes increased in value, right? You actually see cap rate compression because the next buyer is saying there's a lot of upside here. But typically, we're not aiming for those. And of those 5 or 6 acquisitions that are all tied up for Fund 3, they're all new 20-year leases. So you can imagine we're going to buy, we're going to hold for 5-6 years here. And then there's 14, 15 years left of lease term. Now we've aggregated a portfolio with like-kind leases, quarterly financial reporting, annual rental increases, all the fun, force majeure language, the stuff that we've learned over time by studying the big publicly traded REITs and how they craft their leases. So that's very attractive to an institutional buyer on the back end. And for a lot of these folks, they don't transact in under 100, 200, $500 million portfolios, but they like this space, right? Hey, this is private credit manufacturing companies, middle market manufacturing companies around the US, and the real estate that supports them. They can't transact like we are, though, in the $5 to $30 million purchase price range. So a total portfolio of potentially 500, 600 million will be a very nice asset with a weighted average lease term, or they call it WALT in the business, of 13, 14, 15 years. That's very attractive to a buyer, again, with a lot of predictable yield in front of them. And at that point, again, it's cost of capital. So if we do see some reduction in interest rates or some settling there, we could see more upside than we're projecting. We're not building that into our underwriting, but we feel like that would be, again, an upside scenario where we see the cost of lending coming down and see cap rates from net leased assets also moving down with it. The other question you had about what keeps us up at night, it's always black swan, right? You just don't know what you don't know is coming down the pipeline, and it's a scary thing. But When we used to syndicate these deals individually for a long time, there's a lot more risk, right? And again, I mentioned we had a single tenant that defaulted, the only one that did. And that was actually a black swan scenario. The company was very healthy and something happened there. And anyway, we worked through that. There was no loss of capital. Investors, generated a double-digit annualized return. However, that's something you can't foresee. Now in a fund, we feel really good. And oftentimes we look back at the great financial crisis. 2009 is about peak industrial vacancy as well as peak credit defaults. There's about a 6-month period where each default vacancy rate in industrial as well as that credit default rate with similar grade credits was about 10.5%, 11%. Now we can withstand that, right? That's a really deep recession, a short term, but a very tough time in the American economy. We can sustain that level of defaults or vacancies within this fund across, again, anywhere from 20 to 30 assets and continue to have performing assets that can pay the debt service. So we're really, again, feel very good about mitigating the risk of any kind of loss of capital. But in a really tough scenario like that, certainly cash flow is going to get affected if that were to happen, right? But again, I think at the end of the day, we want to protect investor principal, our own principal that we're co-investing, and we feel really comfortable there. So the world is a lot different than 2009, and especially in manufacturing. But again, you want to know that in a really tough recession, how do things look for us?
All right, Chris Lopez, you got time? We got time for probably one last one to put a bow on for Drew here.
Oh, fantastic. Well, I love how both my co-hosts really focused on risk mitigation. I want to shift gears here. Give us a rundown on this first portfolio deal acquisition you're doing. Talk to me about the deal.
Sure. Yeah, I love examples, and sorry I didn't get a time to run through them all, but the first one's one we're excited about. I mentioned, we got blown out of the water, and then they came back to us later on it. It's a 6-property portfolio across Wisconsin, Michigan, and Ohio. The tenant that's doing the sale leaseback is called Robin Sports. Robin Sports is a flooring manufacturer that specializes in gymnasium flooring. They have exclusive contracts with the NBA, NCAA schools. They do private schools and gymnasiums, dance floors. And so they've been doing it for 140 plus years, if you can imagine that. So a pretty incredible track record. And it's a modestly growing business. They're a mid-sized manufacturing business that has, about a 10% EBITDA margin. And we feel very comfortable with them. They were acquired about a year ago by a group called L2 Capital. These guys are a sophisticated operator. They've bought and grown a manufacturing company in their experience. And so we like this business a lot. They're sourcing all of their lumber directly from the U.S., so no worry of tariffs there from Canada. And these are hardwoods. Most of Canadian lumber imports are softwoods. And so these guys, they actually manufacture the hardwoods. I think a lot of them actually end up in panel or sort of modular format, as you've seen the NBA gymnasium floors. They'll bring out an old floor and bring out a new one, and that's the way they do that. But their flooring have actually proven to produce less athletic injuries than other flooring systems. So there's something in the secret sauce to how they manufacture, just to give enough give so that people aren't twisting knees and ankles out there. So God bless them.
All right. Well, hey, this has been fantastic. This portion of the show, Mauricio, Chris, and I are going to stay on and we're going to talk things over. But first and foremost, I want to thank you, Drew, for coming on today. It's been very informative and we appreciate your time.
Thank you, guys. Great questions. Big fan of all of you. I know, Chris, we just met, but Mauricio, I've heard you out there. And Paul, we've been friends for a while now. So great to see you guys, and we'll talk soon.
Thanks, Drew.
Thanks, Drew.
Thanks, Drew.
All right, guys, that was fantastic. Before we dive into some questions here, I just want to disclose that we aren't here to make any recommendations. We're here to just provide additional insights to the opportunity, ask some questions. If you're considering investing, we strongly recommend you make your own conclusions and do some additional research. Let's kick it off, guys. What'd you think of that? Were there any red flags, if any, that you saw in this deal? Mauricio, let's start with you.
I wouldn't say any red flags. Absolutely not. I mean, I got to about 10% of the stuff that I would want to ordinarily ask. So that's kind of, there's a bunch more stuff that I would want to do. Even after talking to Drew or the sponsors, there's stuff, and we can talk about that in a second, what additional things I would be doing just to kind of trust but verify, or just kind of checking in there. But I wouldn't say there was any strong red flags. There were some questions I didn't get to, so I don't want to blame it on Drew. Let me just go through some of this. I love the fact that we have a really experienced team that have been doing it for a long time. As we mentioned in the first session, when it comes to funds, especially funds, you are absolutely betting on the jockey, not the horse. And so I would argue that 90% of your analysis and 90% of your due diligence should be on the sponsors, their track record, how many full cycle deals, what's their experience in the asset class, what's their experience in the marketplace. Like, just that would be most of my research. And then the deal is interesting, but if you don't trust the sponsor, if the sponsor doesn't pass muster, that doesn't go anywhere. I really love their waterfall structure. Again, that's more institutional grade, which is another thing I like. It's like now you're participating in something that really institutionals are doing. I mean, they've got audited financials. They've got a professional fund manager, a professional CPI. I mean, you don't usually get that in a sort of a smaller syndication and stuff. So audited financials was great. The one thing that I didn't get to ask him, I didn't want to get too much in the weeds, was there was a lot of questions I had about their fee structure. And so there were some things in there that seemed really vague to me in terms of what fees they could charge. So that's something I'd want to do a little bit more digging. I would love, and I didn't get to ask him this, whether it was available. I would love to get my hands on the financials of the first two funds, because that'll give me a good idea of like what fees are they actually charging, what are the reimbursable expenses, and kind of get a better idea of the fees as it relates to as a percentage of the fund. But obviously we didn't get into that. And look, some sponsors aren't going to give me that, and that's going to be a decision I need to make. But overall, I thought he did a nice presentation and really, really interesting investment opportunity.
Great synopsis. Chris, what about you? Any red flags or anything that you really liked about the deal? Let's just do two questions at once.
Yeah, no red flags. I mean, pass the sniff test with flying colors. I agree with everything Mauricio said. And also to add on there, I like how they're giving that early class share bump for being early on the fund. If I'm early money in, I always expect a little better economics. I liked his answers and the process for how they're mitigating risk with the tenants on there, because single tenants are great, but either at 100 or 0. So let's avoid the 0 occupancy. And what really impressed me at the end there when he talked about, I think it was Robin Sports, he talked about this first portfolio they're acquiring. Man, he knew that business, which really impressed me. Taking everything from the real estate, everything in the fund, he knew that business so well about who they are, what they're doing, and like their unique selling proposition for a lower injury rate. That really impressed me.
Yeah, that's a great point. I think that the lease term is the value add here, and the credit worthiness of the tenant allows them to feel confident that that tenant will be a payer throughout the course of that lease term. If they're not, that's where they run into trouble. So understanding the business and being able to evaluate that business, down to the granular level is so critical. I would agree with you guys. There's no red flags here for me. I disclosed earlier in the show that I'm an investor of MAG. I'm in 4 different deals with them. 2 of them are industrial single asset deals. One of them is an operating business, and the other one has gone full cycle and was a mezzanine level note on a mixed use development property. I've got the benefit, I guess, of a little bit of a track record myself with this group, and I've felt very confident in their execution, their communication, and, to be now looking at a fund. I agree, Mauricio, that it's so critical to understand that operator and bet on the jockey when they've got all this discretionary capital they're looking to deploy, and you can't underwrite each individual deal. And that's my only watch out, I guess. Even though I have a level of comfort with these guys, I'm probably at a point now where I could trust them with that. But usually I like to underwrite each individual deal and make sure that my risk tolerance is still in line with that operator. It's not that necessarily I wouldn't trust someone, but there has been instances, and actually I will disclose that it was with MAG actually on a different type of asset, where I just felt like, this one for me is a little bit farther out on the risk spectrum. I don't think it's something that I'm going to be able to invest with. So I think it's always good for investors to make sure that risk tolerance line up, because people change, businesses change, risk change, theses change. But in this case, this is right down the fairway for them. This is, sale leaseback, industrial. This is what they do. This is what they've been successful with. 70% of their portfolio has been this type of deal. So from that standpoint, I feel like I'd be pretty comfortable. But I'd also be thinking about the same thing that you thought about, Chris, is getting in early. Because I have concerns about underwriting and what deals make it into the fund, I might be somebody who waits 6 to 9 months towards the tail end of the raise to say, okay, what's in the portfolio currently? Let's look at, the operating businesses. Let's understand how the portfolio has performed in this short period of time. Do I feel comfortable being in this deal for the next 5 to 7 years?
Did you invest in their fund 1 or fund 2, Paul?
I have not, no.
Okay.
To be honest with you, I've only invested in one fund. It was an industrial fund. It was a multifamily fund. And it's an operator with a great track record that has a very good reputation, but that fund right now has paused distributions and is having some difficult times. So that was also along the lines of my question earlier about getting so concentrated over a short period of time. If the market is at a peak and you buy everything in that year that the market's at the top, that portfolio is going to struggle no matter how good the operator is. So that was the case with that other fund.
Let's double tap on that for a little bit, just as sort of an educational piece. I mean, that is the number one difference between a specific single asset syndication and a fund, is that you don't get to see the exact assets that they're going to be investing in. So you don't get to challenge their assumptions. They're going to make a bunch of assumptions when they make those acquisitions. And yes, they have a credit committee. They got all the acquisition team, but you're not going to see that. And so in a single asset syndication, you could look at their assumptions and you may not even agree with them, but you could re-underwrite. Like they may say, look, we're going to increase rents by 5%. And you're like, there's no way they're going to do that. I think they're going to do 2%. They're going to increase occupancy this much. I don't think they can do that. You can re-underwrite it and still determine whether you're comfortable with the investment or not. You can't do that in a fund because you're just literally, once you hand over the cash, they're going to make the investments, which is why I, again, just press on the importance of being super comfortable with the team and the track record, which is why that's something I focus on.
Mauricio, you already touched on some questions you would ask, and I know there were more than we could get to. Chris, was there anything else that was outstanding that you would like to have asked Drew?
I think a good thing for people to know, and I like how they had this, they had the direct investment, which investors get depreciation, and they also had a REIT feeder fund in there as well, which is, more common in bigger funds and deals like this, but I think it's less common in, smaller funds and earlier operators. I would have liked more details on there, and I also think it's very educational for investors to know. Side note here, I've had, investors I've known, investors in some of my deals over the years where they invest in a self-directed IRA, then 2 years later, what's UBIT? What's this? And then they're having to pay, some late taxes and fees on there. So I think it's really great for people to be aware of the nuances of self-directed investing. And when you do get those like REIT feeder funds or UBIT blockers, I personally love those because I do a lot of investing in my retirement accounts as well. So I'd love to just dive into more detail on that with them. Yeah,
that's a great point. Something I consider, but definitely worth looking into if you're in that position. Mauricio, what type of investor do you think this deal would make sense for?
Actually, somebody not necessarily who's looking for a cash flow, because the cash flow this is spinning off is actually below the pref. Like the pref is anywhere from 8 to 10%. They're projecting cash on cash returns of 6 or 7% along the life of the fund. So most of your return is going to happen on the back end. So the type of investor that this is really for is somebody who doesn't need the cash, that's looking for their personal investment philosophy is capital appreciation and sort of a more certainly further out on the risk. Because it all starts with that, right? Paul, Chris, you guys know this. I mean, it all starts with your personal investment philosophy. This particular investment wouldn't fit my personal, because I'm not in, I don't know much about in the industrial space, right? So it's almost already not in my buy box. If your investment philosophy is I need, something that's conservative and cash flowing, then this is probably not for you, right? It's not, neither is a development deal or ground up development that's not going to have cash flow. But if you're somebody younger and you're like, hey, I don't need the cash flow, I've got my other income over here, and I just want to, I want to double my money here in the next 5 years or whatever, then that's kind of, I think, where more this is. And somebody who's a little bit more out there on the risk curve, because this is definitely out on the risk curve. And as a result of that, you're getting rewarded for that. But it all comes back to your personal investment philosophy. Where are you on that spectrum? And if you're further on the left side, conservative, cash flow, money market accounts, this is probably not for you. But if you want to go to, I don't say this is a Vegas kind of thing. That's the other extreme. Like, hey, I just go to Vegas and put it on black. But if you're a little bit more aggressive and you don't need the cash flow right away, and obviously this got some tax benefits as well that'll pass through to you, then this is for you.
You really touched on some great points there as far as personal risk tolerance. I think that is so critical. And I think a lot of LPs miss the boat on identifying what their own risk tolerance actually is, right? So it's critical to know. To me, this doesn't seem as risky as you described it, Mauricio. But I think if you compare it to like a money market fund or a high yield savings account, of course, it's like way out there, right? So it's kind of understanding where your portfolio is from an overall perspective and diversifying and making sure you have some kind of singles and doubles, bunt to get on base, and then you can swing for the fences every now and again too. Chris, what do you think?
So kind of follow up on this discussion, just on like investing thesis. Like I'm less about like cash flow and long term. Like I have a blend of both. That's not a major decision for me. Like my personal thesis for my real estate holdings, I'm probably like 60, 70% like various multifamilies and debt funds. Those are two things I know very well and I like. The other, like, with a 30% or so, I like to make smaller bets in the deals like this where I don't know a single tenant industrial. Like I know a little bit about it, but I'm not, an expert in there by any means. So I like to place personally like smaller investments on there. One is just complete diversification, totally different asset class, totally different geographic asset class, different sponsors, all that stuff. But also the way I learn is if I have money in a deal. I don't pay a lot of attention unless I have some skin in the game. Now, a lot of times I say, hey, for a deal like this, hey, what's the minimum? Can I do a little bit less than the minimum? I want to learn about this, right? Because that's how I like diversification. But it's also I view as my tuition for learning. And maybe in 2 or 3 years as my investment thesis on how to structure my portfolio, it may change. I may start weighting more towards that or different asset class.
Makes sense. All right. You guys kind of alluded to it a little bit. We'll start with you, Mauricio. Is this a deal that you would consider investing in?
No, but again, not because it's a good deal or a bad deal. It just doesn't fit my personal investment philosophy. And that's what I said. It doesn't fit my buy box. So that's the only reason, honestly, if it wasn't for this presentation, I wouldn't even looked at it, because it's just, first of all, I don't usually invest in blind funds. I prefer to invest directly in single assets. I would say I don't know anything about industrial. So, but that's the reason. But if you're somebody who, likes the industrial space and loves the sort of the blind fund model, and which a lot of people do, then I would definitely take a good look at this one, especially because, and almost exclusively because of the track record of the sponsors. They have just a great track record. I did a little bit of digging around, couldn't find anything. I mean, again, that's more due diligence you'd want to do. I made my notes here, and I know some people who know them pretty well. So I would probably pick up the phone, give them a call, say, hey, anything I'm missing? I'd want to reach out to LPs, not the LPs they gave me, but for me to find LPs in the deals. Paul, you're one of them. So I'd be talking to you and say, hey, Paul, how is their reporting? How is their communication? How is their, what, blah, blah, blah. I'd love to look at their financials from the first couple funds to see, what that looks like in the track record from those, because those are already similar track records. And then look, if I'm putting in $250,000, if I'm in that 250 range, I might be hiring somebody to do a little bit more of a sort of a deep dive on the background of the whole team, whether it's civil, criminal, like all this stuff. And I mean, you can spend, there are firms that'll charge you $25,000 to do that due diligence. I'm not saying I would do that, but certainly for a couple grand, you can get a lot more deeper due diligence that's not going to be found on Google.
Yeah, great points. And Mauricio, I think you touched on the power of the PassivePockets community, right? If you need to pick up the phone or find somebody who's invested prior to with a sponsor that you're considering, you've got a Rolodex of people that you can reach right on the forums and build relationships with, et cetera, et cetera. Chris, your take.
Yeah, so it's interesting. You guys sound like you're more single asset guys. I'm more of a fund guy. So I like this a lot. Like I said, you already heard my investment thesis. And personally, I'd rather invest $100,000 into a fund for, hey, I'll get a part of 5, 10, 15 deals than $100,000 in a single asset, just for, I think that's greater risk mitigation. The other thing is I'm a big macro trends person. I've made a lot of money over the years in business and investing when I just rode the big trends. When I try to do, stock day trading or short-term trading or flips, I have a lot less impressive track record. And I think with, where a lot of the policies and, where the onshoring is in America, I think that's a very big tailwind right now. Now, again, I'm not an expert on that, but I'm actually going to dig a lot more into this later this week. I'm very interested, and I'll dig in more.
Yeah, I'm with you on that. I am interested, based on my prior dealings with Mag. What I want to be cautious of is just my sort of penchant for wanting to stick with the single asset deals and stay away from the semi-blind pool funds. But I think, given my experience with them has been positive, maybe I should put that to rest, because I really like the diversification piece and being able to, spread my bets amongst a bunch of different assets with a professional team managing it. But if I do, I think I'll just wait a little while and kind of see how the fund goes, how much capital they're raising, what assets are they bringing into the fund, maybe evaluate some of those assets and just get a little bit more comfortable. Well, guys, that pretty much wraps it up. I want to thank you, Mauricio and Chris, for joining us today. And I thought that was a great episode and outstanding questions. So great job. And that wraps up this deal review episode. A big thank you to Drew Wahlgren from Mag Capital Partners for presenting their deal, and to my fellow LP panelists, Chris Lopez and Mauricio Rauld, for sharing their expertise. We hope this episode gave you valuable insights into what experienced limited partners look for in a syndication deal, the questions they ask, and the factors they consider before making an investment decision. Thanks for tuning in, and as always, happy investing.